I'm Charlotte McLeod with the Investing News Network, and here today with me is Gareth Soloway, Chief Market Strategist at InTheMoneyStocks.com. Thank you so much for joining me online today. Great to see you.
Great to see you too, Charlotte. Thanks for having me back.
Yeah, really excited to talk to you. And I think I mentioned this before. It seems like we're always talking either just before or just after we get news from the Fed. This time it is just after. Earlier this week, we had the first Federal Open Market Committee meeting of the year. So I think we need to start there and just get your takeaways on what we should know from this event.
Yeah, so the Fed definitely remaining very, very hawkish. I think the market, and we've seen the volatility kick into the markets, and the NASDAQ especially has been selling S&P, Russell 2000, and it's all selling because the Fed appears to be a little bit in panic mode, right? So, initially it was, transitory inflation, and they insisted on that for months and months and months, finally admitting, oh, it's not transitory. Now they're at the point where they're worried about inflation, and it's showing itself because they're not just saying, hey, we're going to taper, but they're saying we're going to taper, then raise rates, and then reduce our balance sheet. And I think that's a lot for the market to stomach. The market's been in this mode of easy money policy for so long, and it almost looks like the Fed is panicking a little bit and just saying, hey, we got to cut off all this stuff right now to get inflation under our belt. And I think, again, that's a risk for the economy, because the worry here is, at least for me as an investor, is that if they do too much here and they panic and tighten too much, they could actually derail the bullish economy right now and cause a recession. Now, in the longer scheme of things, if we start to see weakening economic data, then you might actually see the Fed loosen policy again, which maybe for equities is a good thing down the line. But again, we just got to kind of play it by ear.
Yeah, that's exactly what I was hoping we could talk about. We have all these things in play now. We have the tapering that's supposed to wrap up. We have rate hikes that are then supposed to start. And now we also have the balance sheet kind of discussion starting to begin. So can you help us unravel those three things? And what do you think is the most important here for investors to pay attention to?
So I think the market was anticipating the tapering, because the tapering was something that was, the QE essentially was something that was put into place at the beginning of COVID in March of 2020, and it was meant as kind of a emergency measure. So we always knew that was going to come off the table. With a stronger economy, you figured, okay, some rate hikes in the mix there if we're really strong. I think what shocked the market, and you saw this, right? We knew that they were going to do those first two measures mid last year, right? We knew that was going to come. But what we didn't know was the reduction in balance sheet, which is $9 trillion or more at this point. Now, how much they reduce it by, we don't know. But again, I think that was kind of the straw that broke the camel's back for the equity markets, where we started to then see these big moves to the downside, 2%, 3% drops in the US markets.
Yeah, and this is quite interesting. I think we've talked about this together before about how Powell has been pretty clear about what's going to happen. There are not really a lot of surprises when we get to these meetings, but this does seem to have been a little bit surprising for people. So maybe, how does that all fit in?
Yeah, so it definitely was a surprise, which the markets do not like, right? Markets do not like what they don't see choreographed, miles ahead of time, essentially. So I think for the markets, they're saying to themselves, okay, well, the Fed was off on the inflation being transitory. Now they're showing us this kind of panicked, we got to do all this at once type thing. And that's the real risk, because if you look at since, you could argue at least from 2009, the markets have been grinding higher with a few blips, but for the most part, it's because the Fed has always been there and the markets have trusted that the Fed will always be there. And now with inflation spiking, the question is, number one, did the Fed, miss the ball here and not start tightening a year ago, for instance? And then number two is, can they even get inflation back under wraps? And, I'm very skeptical. I think, 8-7% inflation where we are right now, I certainly don't think we're going to stay there. I think you will see, as supply chain kind of is dealt with, we'll get inflation down. But the concern here is, does it get below 5% or 4%? I don't think it goes back to 2%, considering the wage hikes that have occurred that will be passed along in the consumer products over the next multiple years. So my forecasts are showing 4 to 5% inflation over the next 3 years, 4 years. And I think that's going to put a very tight situation for the Federal Reserve, where what happens when we do enter a recession, when unemployment goes up? How does the Fed react with an inflation number that's staying sticky around 4 or 5%?
Right. And let's talk a little bit more about what's going on in the overall market. So they were not happy with this news from the Fed, although really we've been seeing declines since the start of the new year. So probably I think what people are wondering is this going to continue? That's pretty tough to answer, but what are your thoughts there?
So I have a really interesting chart here I'd like to show. It's the S&P or the Spiders ETF. And what you can see here is that you had a definitive kind of move up when the extraordinary measures were introduced for COVID. So here was your COVID dip, right? There was your COVID panic. And then from that, you got this incredible kind of stimulus that the Fed and the US government put into play. And you could see the vertical nature of the markets and how it stayed in this kind of channel, right? We have this lower channel line, you had this upper channel line, and it was just a constant grind higher until recently. And this to me stands out as a breakdown of trend. And I think what's important also is to recognize that if you zoom out on this chart and you go back to 2013, 14, 15, the long-term trend for the markets was here. And it only makes sense to me that if you're really getting rid of these extraordinary measures that the Fed put into place, that you should see more downside into this area here, right? So you probably come back in this range at some point, which brings us back to that kind of fair value that the markets were in. Now, if we start to slip into a recession, do we go below that? Maybe. But at this point, in the very least, you can see how the market ripped higher on that kind of steroidal push by so much stimulus. And now, again, being taken away, it only makes sense that we come back in that kind of longer term trend on the market. So that's kind of where I'm at right now, where I still think there's more downside. You're going to get great bounces along the way. We're seeing a decent bounce today in the equity markets after some economic data came in a little bit better that the market wanted to see. But I certainly think there's more downside.
Right. And, the market reaction, I think, kind of reflects confidence that the Fed is going to be able to do what it says it will do and follow these plans it's laid out. I know that you don't necessarily believe that that's true. So what are you thinking as we move forward into 2022 from the Fed in terms of, what it can actually accomplish?
Yeah, I mean, the track record of the Fed since 1977, when they received the dual mandate, which included unemployment at that point, has been one where, we have a recession, they lower interest rates a lot. And then when we come out of that recession, they only raise interest rates a little bit before the next recession. And so it's kind of been a stair step where you come down, a little bit of a bounce, come down, and that's how interest rates have gone. So I'm very skeptical that they can get us back to anything resembling even the new normal on interest rates, the balance sheet getting down reasonably to maybe 3 trillion or even 4 trillion without them causing another recession. And then the question is, well, if they do cause another recession, what measures can they employ? I mean, do they just go back to printing money nonstop to stimulate again? Then what happens to inflation? What if inflation's at 4% instead of 2% at that point? Do we see a 12% handle on inflation? So the Fed is really in a tight box here. I'm hopeful that there's something that they can maneuver to kind of get us out without causing massive inflation, but it's certainly something where I don't think they're going to be able to raise more than two times in 2022.
Okay, now let's move over to gold and talk about how gold has reacted to this week's news. We've seen a decline. Right now, we're talking on Friday. It's under 1,800 the last time I checked, although gold had been rising throughout January. So I wonder if you can review gold's recent price action and how we may see it perform as we head toward, the next Fed meeting when we'll get some more news on what they plan.
Yeah. So looking at the chart, it's amazing because the chart is so accurate in calling these levels, right? So what's amazing to me about the gold chart is that if you connect all the recent highs, including the one from just literally a few days ago, look at how it was right into that trend line. And then we've pulled back here. And what you can do is you can also connect all the same low levels. So what this tells us is gold is still trading in a range, right? It's what we call a wedge pattern. I'm still in the camp that we do see a breakout of the wedge pattern to the upside. And once we break out over this top downsloping trend line, you should very quickly kind of go to the former all-time high of from 2020, which was around 2,075 per ounce on gold. Now, one of the things to keep in mind is gold is behaving exactly like it did in the mid 70s, right? So you have the big move up starting in 2018 and ending in 2020, right? So it was about a 2-year move up. And now we've been consolidating for getting close to a year and a half to 2 years. And I'd love to show this chart. If I go to my monthly chart and we go back to the 1970s, and bear with me as I kind of get the chart set up for us, you can see that same sort of price action. So in the early 70s, when there wasn't a ton of inflation yet, you had a big move up. I look at this as what happened between 2018 and 2020. Then when inflation started to bubble up in 75, 76, gold actually went down and consolidated here for about 2 years. It wasn't until kind of 77, 78 where gold had this epic move to the upside, where it went from $100 to about $800 to $900 an ounce. So what I'm thinking is that in the scheme of replication, right? And if you look at the inflation data, it's very consistent with what we saw in the mid 70s to 80s. And if this move is replicating, we're probably right around here in this range here on this move in gold currently. And I do expect a big move to the upside. Now, again, from $100 to 800 or 900, I don't think percentage wise we're going to do that with gold. Maybe we do, but I would highly doubt that much. But do I think we can go to $3,000 to $5,000 an ounce in the next 5 years? Yeah, I do. I actually do think that is a possibility, because again, I'm so doubtful that the Fed can ever really, fully tighten and remove all monetary policy. So essentially you have so much US debt, you have the Fed in a predicament with recessions and having to just print more money, that inevitably they're going to have to go back to that game plan, increasing the dollars out there and then ultimately driving up gold.
Right. And I think this is quite informative, because as we've been seeing inflation over the last year or so, I know there's been a lot of people saying, well, isn't gold a hedge against inflation? Why is it simply, kind of going along as it was instead of increasing? But if we look back, as you're saying, we can kind of understand how that pattern plays out.
Yes, that's exactly right. And I think it makes sense from a psychological aspect too, because, you had the big run from 2018 to 2020. I think honestly, that was the gold market anticipating a rise in inflation, right? So, they saw what the Fed was doing. They saw the amount of printing going on, and they said, okay, we got to readjust gold's price. And now you've kind of gotten this period where investors are saying, okay, well, we see the inflation that gold was predicting by that bigger move, but is it going to last? And as soon as you see signs that it's going to last longer, the gold market will very quickly kind of react to that and start its upward move, in my opinion.
Okay, I think that's really helpful. Let's also check in on Bitcoin. We've been talking about that over the last year or so. And I remember that you have you're seeing that it will go to 20,000, maybe even below. It has not been exempt from the downward momentum this week, this month. So let's check in on that and what you're seeing there. Do you have a time horizon for that downward move?
So, right now I'm predicting a short-term bounce. You could see from this is such a cool chart, and I love showing this, because you basically had a scenario where if you took the high from April to the low here, all right, that distance was 100% replicated from this high to this low. And that's how you get these perfectly parallel trend lines, right? So we have a situation where on a short-term basis, you have support. We have seen Bitcoin bounce a little bit. And then very near term, over the next few weeks, I think you get a move back to 40, maybe 45,000, somewhere in that vicinity. But by no means is the deleveraging in the system over, right? So at some point we come back down and we break below. When we do break below this, then I do think you break below 30,000 and you actually can easily go back to 20 or even sub 20,000. And I think it's important for investors to realize that Bitcoin, everyone wants to talk about Bitcoin like a hedge against inflation, like a safety trade, like, oh, when the Fed prints a lot of money, it's great to be in Bitcoin. And with this, it should rise. But in reality, it's treated more like a tech stock, because it's in its infancy, right? It's only been around for now 13 years. In the scheme of things, that's very new. It's very, very volatile. We know that from past drops. And so you have to look back and say, okay, in 2013, when it made its high, it dropped 80%. In 2017, it dropped 80%. So what's to stop it from dropping 80% when you potentially see one of the biggest deleveragings in the system that we have ever seen, right? With the Fed seeing inflation and trying to pull back. So, considering it's already pulled back almost 50% from the all-time high in November, just imagine if the stock market deleverages and goes down 20 or 25% on the S&P 500, it shouldn't be a stretch to think that we could at least reattack the 20,000 level, which was the 2017 high. So again, I love Bitcoin long term. I think there's real value there. I do eventually think it grows into that alternate digital gold type thing. But at this time, it was a lot of fluff. It's got a lot of spec money in it, and it has to continue to deleverage. So I do think, there is more downside after a near-term bounce here.
Okay, I'm going to ask you to talk a little bit more about that because I think that's a really key idea, thinking about Bitcoin as more like a tech stock than something that's akin to like gold. Because coming from, the gold perspective, we do hear things like, is it the new gold? Are they equivalent? Can you use them for the same things? And, looking at your predictions of gold going higher, Bitcoin going lower, that might be a little bit scary for people. So yeah, maybe if there's anything else you would share there.
Yeah, so I think you have to think about Bitcoin and digital currencies as a new technology, right? So you have the blockchain. I liken it, and I've said this before, like think about the .coms. For those of you that are a little older watching this and you lived through the .coms, the .coms it was a brand new technology coming to the masses, right? I mean, I still remember it vividly. It was my very early investing career, and you could finally get online. You could go to websites. I mean, it was, dial up. It took you like 3 minutes to get online, but it was going to change the world, right? That's what everyone was saying. And they were right. They absolutely were right. The internet did change the world. But that hype led into .com companies coming public that should have never been public. They were being run out of their parents' basement. They had $100 million valuations. They had no revenues, no chance of ever being profitable. And then you look at what's going on with cryptocurrency, how it's a new technology. It's going to change the world. It's the digital gold. It's, being used for transactions. It's going to, revolutionize. It's the same type of chatter that was during that period. And what we know is that eventually the .coms got washed out and 95% of them no longer exist, right? Now, the ones that survived, like an Amazon, which dropped 95% during that collapse, I mean, it ended up thriving, right? I mean, it was $5 in 2000, 2001. It's now 33,000 and change. So there's going to be massive opportunity, but you have to let the garbage get flushed out first. And in fact, that's healthy to do. Right. So again, because it's a new technology, it's being treated like a new technology company. And therefore, you're seeing spec money running it up, and also on the way down, spec money selling it and panicking on the way down. So again, 5-10 years from now, I think it starts to mature into a asset that is something that's more stable, that institutions want to hold, or corporations want to hold on their balance sheet to diversify from dollars. But at this point, it is still a new asset. People are still trying to figure out its reliance. And also there's no regulation too, right? And you have to get that regulation in to kind of coax in more investors, right? If you're 65, 70 years old, and there are some of those people that are investing in digital assets, for the most part, they're not. And I don't blame them. It's scary. Someone can, fish with a link, and they can jump in your account, steal your Bitcoin, and you have no repercussions. You don't get your money back. So the government needs to come in and make it safer, and kind of say that, okay, we're going to back this new technology, and then it'll start to do much, much better.
Okay, I think that's really helpful. So thank you for that. I have one small sidebar before we let you go. You recently posted a video on oil and making the case for a potential crash in the market here. So I want to get your thoughts on that and how you're seeing it, because I've been hearing recently, from a supply demand perspective, some very bullish predictions on the market. You obviously take quite a charts-based approach to it. So what are you seeing that makes you say that?
So what's really going on here, and what I'm concerned with, is number one, we've seen the equity market starting to roll over significantly, right? So the stock market, NASDAQ, Russell, S&P, all rolling over. Now, oil is still running up. We're at a short-term high. I think this is the highest point oil's been since maybe 2014. And I actually think that oil could get to $90 to $100. But what scares me is that if we are really going into a tighter environment on money supply, then you may be replicating 2008. And what's fascinating about 2008 here is that you had the same situation where the stock market topped in 2007, and oil had this epic run to $145 a barrel into 2008. Now, in 2008, because the Fed was tightening, because things were starting to deteriorate and the economy was starting to slow, oil then began to follow the stock market and collapse lower. It just lagged it by about 6 to 8 months. So the fear here is that oil is replicating that same move. And the thesis for why it's replicating is because when you have, when institutions initially enter the beginnings of a bear market, and investors are like this too, you don't just exit the market in its entirety, right? You just don't say, okay, I'm going to sell everything, because inevitably we want to be invested. So what we do is we start to look for areas that are safer, that we can still make money. So we sell our tech stocks, let's say, which is what's happened recently, and money flows into oil. All right. And that's exactly what happened in 2007. So oil continues up, money just keeps going in there. It pushes it up, up, up. And then all of a sudden, because of the tightening of the Fed, just like in 2007, the economy starts to sputter, which now takes away the reason why oil has gone up so much, which was demand, right? And you start to see oil collapsing. And I can show you here. Let's quickly go to the monthly chart on oil. And you can clearly see here, and here's their big run, right? So here's your run on the monthly on oil. I mean, it was just an epic run where it went up to $145. And then what's scary for oil investors and why you got to be ready to get out. And again, it might go to 100. We don't know the high here. But when it started to collapse, it was so fast and furious, playing catch up to the equity markets. So again, take a look at this. The high on oil occurred in June, July of 2008. If we go to the S&P 500, you can actually see the high in the S&P 500 was in October of 2007. But notice how the bottom was put in February, March in the S&P. And if we go to WTI again, the oil bottom was also put in that same period. So what it means is that oil eventually caught up on the sell side after collapsing from $145 down to about $33 per barrel. So, the idea here is that, money is rotating because investors and funds really have to be invested. But as the cycle goes on and the markets get nastier and nastier, the economy deteriorates, and then the institutions jump ship so quickly that it kind of makes your head spin, and oil tends to collapse very, very quickly.
Okay, thank you for explaining that. I think it's great to get a different perspective on some of the things that we've been hearing. As we're wrapping up here, I have one final question, and maybe the most important one that people will definitely want to listen to. You always tell us that there is a trade to be found no matter what's going on. So it's quite chaotic right now. Where are you looking for opportunities? And you've kind of hinted at some things, but just to, narrow it down.
Yeah. So I always believe there's opportunities, and I want to be clear on that to everyone watching, is that, maybe I don't like certain stocks or the indices, and I think the markets are going to go lower, but there absolutely are places to invest. So for me, and I can just speak from what I'm doing, I have positions in gold right now, gold miners. I do believe that, again, we'll have a breakout by, mid-year on gold, significant move to the upside the rest of the year. In addition, I'm really looking at foreign stocks, right? So since COVID and even before that, because the Federal Reserve was so money printing happy, that money from global investors flooded into the US, domestic users only invested in the US, and hedge funds and institutions are extremely underweight, just like investors are, average investors in foreign equities, right? So the idea is, as the Fed gets more hawkish, money is going to start to look for other countries where their feds or their governments aren't as hawkish, and it's going to kind of revert to the mean. So you're looking at, names, for instance, like Alibaba, which has just been clobbered. We've seen Alibaba come from $300 down to 113 at this point. Something like that, where the valuation, I think the PE ratio on Alibaba for 2022, the forward PE is only 10. Right. And here's a growth stock with 1.5 billion Chinese potential consumers that is trading at a 10 PE. So, I mean, again, there's no guarantees in investing, right? We don't know what the Chinese government's going to do. You have to take that into account when you're investing. But some Chinese stocks are very interesting to me. South America is very interesting to me. So again, there are places to hide, I think, in a market that's kind of in a bear market, at least in the United States.
Okay, well, we'll wrap it up there for now. Thank you so much for sharing all your thoughts. Always great to hear what you have to say.
Thank you so much, Charlotte, for having me.
Of course. And once again, I'm Charlotte McLeod with the Investing News Network, and this is Gareth Soloway with InTheMoneyStocks.com.